Okay, Assalamu alaikum. Good day, audience. This is your SBR trainer, Mustafa Mirchawala from Mirchawala's Hub of Accountancy, right? Okay. In the beginning, I would like to share some of the results just for your motivation because these students, you can see the screen, these students were also like you. They studied the way you guys are studying, and they scored such a good marks in the last recent attempt. See the September 2020 attempt, recent attempt they scored. And in this list, two students are position order, like Zainab Sri Lanka. She got highest in Sri Lanka, whole Sri Lanka, that's Sri Lanka top. And the second guy is this is Saudi guy. What's the name of that Saudi guy? Yes, Ammar Saudia also got Saudi top, right? So these were also normal students. They also followed the instructions given by their teacher. Simple. They just obeyed the teachers. And for these last days, especially last days, the first thing I expect from all of you is at least you have done your normal course. You have attended the normal course. At least you have done this, because the biggest reason of failure is time pressure. Normally, what students do, they complete the course on the last days, very last days, like 2 or 3 days before. So they don't get time for revision. They don't get time for articles reading. They don't get time for solving the mock exam, marking facility. They don't avail all, nothing. They skip all these things. So that's high risk. Still you can clear. I say if you just attend the lectures and you go and give the paper, still you can clear. There is a possibility, but this scenario is risky. So if you want to go risk free, it's better at least 20 days, 17 days before the exam you have covered your course. Then you do your revision, you watch revision days, you avail the marking facility. Now, since last few attempts, I am giving a special marking facility to all my students, even to the external students as well. This time that's why I've written the email ID here. So you can send your scripts. You can send your scripts at this email ID, examination scripts. Look at here, examination scripts @gmail.com. The examination scripts @gmail.com. Okay. So we'll give you the feedback. Okay. In this way, you'll come to know what are your mistakes. I have made different short videos even for the feedback of students. This is the normal issue that some students try to write the thesis. That's also wrong. They write too much. There are some students, they don't connect things. There are some students, they don't connect with the question. They just copy paste it. They just copy paste what they have learned. They just write the IFRS. They have no skills to connect with the questions, right? Okay. So try to be relevant, try to give answer and points. Also, one thing, do practice on examination software before the exam. Don't try it on the first time in the exam. Okay. And you have, in the exam, you have two options. You have Word file as well as a spreadsheet. In my previous lectures, which is already available on YouTube as well, I'll send you the link after the class. I have discussed it's better to solve the complete paper on Word. It's better to solve complete paper on Word, right? Because when you use two sheets like spreadsheet, when you use two things like spreadsheet and as well as the word processing file, it's difficult for you guys to connect. So 90%, 85% SBR paper is theory based. So it's about typing. So better you do the practical work in the word processing. Like for Goodwill calculation, you can make the table. There is a table option. You can make the table and you can do the calculation in that table, right? Okay. So it's better to solve complete paper on the word processing. That's my recommendation, and you should try it. Okay. Give proper referencing to connect things like working 1, working 2, working 3. It's better because in past, ACCA guys trained us in a teacher's training session. They told us this thing, that the reason of failure of student is poor handwriting and poor layout. I agree. Now there is no more handwriting issue because it's about typing now. So but still it's poor layout or poor presentation. So be careful about the presentation. Okay. Because now you guys are studying a professional paper, and examiner expects something professional from you, right? So just think, you have to address, sometime you have to address investors, sometime you have to address the board of directors. So it's better to use proper formatting, heading, like these things, right? Okay. Now, moving forward, this I have taken some words of examiners from the recent examiner report. Read this thing. See, in a recent paper, in question number 4B, requirement was to explain to investors. See, this was the word, explain to investors. Examiner itself saying to explain to investor, not explain to a chartered accountant. So for investors, you need to do some sort of spoon feeding as well. You are communicating to a common man. So just number crunching or just do numeric thing is not enough, because investors wants to know what investor wants to know what is happening in the company. Okay, so see, these are the comments of examiner. Read it. Many candidates simply give a numerical response. Many candidates simply give the numerical response with little or no explanation. So if you do these things, definitely you'll lose the marks. Okay, so it's about theory. Just wait 30 seconds. It's Azan break. Okay, now next they say many students don't connect reply according to questions. Simply they copy paste the IS IFRS thing. I just told you this thing. Okay, so just the knowledge of IS IFRS is not enough. You have to connect. You have to connect according to the context. Okay, at least use the name of that company so that the examiner feels that you are connecting. Try to discuss the issue with what is happening in the question, right? Then in a recent question number 1, it's question number 1 about consolidation, major about consolidation. It was written in an explanatory note to discuss principle and practices used linked to given scenarios. It was about goodwill calculation and different types of consideration. Goodwill calculation and different types of consideration, right? Okay, so it was a 11 mark requirement. Just saying, do you think for 11 mark requirement, for 11 mark requirement, just a number, just calculating goodwill is enough? Just calculating goodwill and making 2 or 3 entries is enough? Not at all. Not at all. Now for 11 marks, try to see the weightage, how much marks examiner is giving to you for this thing. So now you need to elaborate each and everything, starting from the COI, cost of investment. For example, there are 2 types of cost of investment: contingent consideration and deferred consideration, or contingent consideration and shares consideration. You need to explain each and every step. Then you need to come to the fair value of net asset thing, everything. Even sometimes it happens, be very careful with consolidation. There is one greater link of IFRS 13 fair value measurement, IFRS 13, right? Because in consolidation, different types of consideration, you need to record it at fair value. So yes, there's a use of fair value, so IFRS 13 must come. IFRS 13 must come here. Okay, similarly, this is the requirement. You all know, I'm sure you all guys know, this is the requirement of IFRS 3 to record complete S company, at fair value at the date of takeover, right? Because the formula of goodwill is COI, cost of investment less fair value of net assets of S company. Cost of investment less fair value of net assets of S company. So definitely when you need to calculate complete S company at fair value, so dear students, IFRS 13 has a greater link. IFRS 13 has a big link with this consolidation thing. Okay, now listen very carefully. Today's class, it's about consolidation. I'm going to revise consolidation things, and yes, don't take consolidation as an easy topic. Normally, what is the perception of students? Listen, many students even text me, they say that question number 1, 2 is comparatively easy as compared to 3 and 4. This is the market feedback, right? But if you see, I have solved complete March June 21 paper and I have uploaded on YouTube as well, just for the students. So if you see that past paper, I have proved in that past paper that question number 3 and 4 was easier than 1 and 2 in March June 21. You can see that past paper. You can see that past paper, that question number 3 and 4 was easier. So it happens sometimes they give, it's up to the examination, they give you a technical story of consolidation. Okay, so our today's class objective is to discuss consolidation, to revise consolidation things, and I'll try to revise maximum things related to question number 1, consolidation part. Okay, but yes, keep one thing in mind, that this is revision days, these are not normal classes, obviously. So definitely I don't want to go in extreme depth as in my normal classes. I go in extreme depth, obviously. Those are normal classes. Okay, but now we have limited time, so we have to cover many things. Okay, one more thing I would like to tell all of you, that for current issue, many students think a lot about current issue. It's not, it's first of all, now I can say this, you can't predict it. You can't predict it. We teachers, we have conducted many sessions on current issue in past. Latest, what we call it, latest is exposure drafts we have discussed. Even on YouTube I have discussed many. But normally you can't guess current issue. They in the end, examiner gives a general topic, very general topic, like sustainable reporting, like integrated reporting, management commentary, very general, or criticism on a certain IS, right? So it's better, listen, first of all, I have uploaded few classes of current issue on the YouTube. You can watch those 2 or 3 classes, you will get an idea. Number 2, second thing, read all the articles, read all the latest articles on accaglobal.com. I say to my students, keep at least 2 days for reading, special 2 or 3 days for reading articles, examiner report, even that report as well, that what mistakes, your SBR examiner has written few articles, 2 articles, I think, that what mistakes a student do in the examination. You all must read those things. Okay, keep at least 2 days for this reading things, because if you read more, you will be able to connect more. Okay, right? Now for consolidation, let me give you a quick thing. First of all, there are 2 methods, proportionate method and full goodwill method. Proportionate method and full goodwill method, what are the difference? First of all, goodwill calculation is different. What's the difference? In proportionate method, we only calculate, let us say we have 80-70% holding, so parent company only calculates and record 80% or 70% goodwill, 80% or 70% goodwill, right? Okay, so the formula for goodwill calculation in proportionate method is COI less fair value of net assets multiplied by the holding percentage. Okay, so you get 80%. But in full goodwill method, definitely we record 100% goodwill of S company. So the format is COI add fair value of NCI, fair value of NCI at acquisition. Hope you remember it. Okay, number 2, NCI calculation is different. In proportionate method, how you calculate NCI? You copy S company's net assets figure at the reporting date. You copy paste the S company's fair value of net assets at the reporting date times NCI holding percent times NCI holding percentage. Very simple. But for full goodwill method, in full goodwill method, NCI is reported at fair value. NCI is reported at fair value. So what you do, you pick the fair value of NCI at acquisition and you adjust S company's post net asset share. You adjust S company's post net asset share in that fair value of NCI at acquisition to get the fair NCI number. Okay, so the first difference is goodwill calculation is different. Number two, quick, please be active. In this class, we'll be able to recall many concepts of many important concepts of consolidation. Okay, but I need your support, your activeness. Listen. So the third thing is consolidated retained earning. The calculation of consolidated retained earning in both methods is same. P company's complete retained earning we write, year-end retained earning, and S company's post retained earning share. S company's post retained earning share. Okay, this is what we do. Now, There is a fourth difference. There is a fourth difference, very interesting difference. Listen, and that is impairment of goodwill calculation as well as posting. Impairment of goodwill calculation through CGU as well as posting. Sometimes they test this area as well. In last 2 years, they have tested this area as well. So I'll try to give you a quick recap of this area. Impairment of goodwill calculation through CGU using both methods as well as their posting. Look at here. Listen, for example, you have two dates. This is 1st January 20, this is acquisition date, and 31st December 20, this is reporting date, my dear student. Okay, and let us say I say P company has 80, P company bought 80% shares of S company. Okay, P company bought 80% shares of S company, and right now we are doing proportionate method. Okay, so you know how to calculate goodwill. Listen, let us say your COI is 20,000, your cost of investment is 20,000, and this packet is acquisition date net asset. This packet is acquisition date, wait, this packet is acquisition date net assets, so it's 20,000. And assuming there is no fair value adjustment right now, just ignore the fair value adjustment. Just assume this acquisition date net asset packet already at fair value. Okay, so you will pick this fair value of net asset is 20,000, and now you tell me, as it is the proportionate method, so we have to calculate only 80% goodwill. So your COI, cost of investment, is equal to 80%. So definitely you will multiply this by 80%. So 20,000 times 80% is 16. 4,000 is your goodwill. 4,000 is your goodwill. This is, my dear student, it's pure proportionate method. It's pure proportionate method. Okay, now at the end of this first year, we need to do impairment testing, because your subsidiary is a CGU, and this CGU, students, listen, look at here, this CGU has a goodwill in it. And we all know, according to IS 36, purchased goodwill must be tested for impairment at least annually. Purchased goodwill must be tested for impairment at least annually, right? Okay, so what's the game? Listen, your net assets at the year end is 40,000. Your net assets at the year end is how much? 40,000. Now be very careful. Listen, we are doing proportionate method. Now look at here. In proportionate method, this is CGU working. Your net asset is 40,000, but you know, in proportionate method, we just calculate goodwill at 80%. We just calculate 80% goodwill. So if I write goodwill of 4,000, this is equal to already 80%. So when your goodwill is at 80%, so you will convert everything into 80%. When your goodwill is at 80%, so think mathematically, we'll convert everything to 80%. So your net assets of S company is 40,000 times 80% is equal to 32,000. Okay, now you have a question, sir. You just pick the net assets. From S companies, this data. Doesn't it include goodwill already? No. I just picked this 40,000 from S companies individual books. And in S companies individual books, goodwill is not already adjusted. In S companies individual books, goodwill is not already adjusted, right? Okay, so now this 32,000 is already at 80%. We just converted this thing at 80%. Goodwill was already at 80%. So 32 plus 4 is 36,000. This we call carrying value of net assets. Carrying value of CGU. So dear student, this carrying value of CGU is already at 80%. Now, next thing. In the question, recoverable amount of this CGU will be given. So the recoverable amount is CGU is 42,000, and this 42,000 means 100%. This 42,000 means 100 complete subsidiaries recoverable amount. Complete subsidiaries recoverable amount. Just think everything is at 80%. From top to bottom, everything is at 80%. So we'll convert this in 80% as well. So can anybody tell me what is the 80% of 42,000? What is the 80%? Yes, it's 33,600. Thank you. 33,600. Now students, look at here. Look at here. Now, your carrying value is 36,000 and recoverable amount is 33,600. So whenever your carrying value is higher than recoverable amount, whenever your carrying value is higher than recoverable amount, impairment is must. Impairment is must. Okay. So how much is the impairment? I think it's 2,400. Thank you. It's 2,400 is your impairment. Okay. So now use your brain, use your common sense, use your brain and use your common sense. You just calculated the impairment 2,400 for this CGU, and yes, we are using proportionate method. Now, how to calculate? You think about your past, how to spread this impairment over CGU, how to spread this impairment of this over CGU. The first step is obvious impairment. If a specific asset is given for obvious impairment, then you do, but there is no hint about obvious impairment. So obviously you remove the goodwill. Okay, listen, how much is the impairment? It's 2,400. And how much is the goodwill? See, this is 2,400 and the goodwill is only 4,000. Goodwill, the total amount of goodwill is 4,000. So complete, look at here, this complete impairment will be allocated to goodwill. This complete impairment will be allocated to goodwill. Now, the very important thing, how to post this impairment, how to make the entry or how to post this impairment. I'll tell you everything. Listen, in proportionate method, my dear student, use your brain. In proportionate method, goodwill is considered to be a complete asset of P company because goodwill is at 80%. P company bought 80% shares and we have already recorded goodwill at 80%. So in proportionate method, goodwill is considered to be a purchased asset of P company, pure asset of P company. Listen. So when P company assets go down, it's an expense of P company. And when we book expense of P company profits will go down. And so the consolidated reserve will go down. So this goodwill impairment, this proportionate method goodwill impairment will purely go in consolidated reserve. So the entry will be CR debit 2,400 and goodwill credit 2,400. CR debit 2,400 and goodwill credit 2,400. This is the entry. Complete impairment of goodwill. Complete impairment of goodwill will go in consolidated reserve because of this proportionate method. Okay, just have a look because the time is very important now. You got it? Now, the next thing is full goodwill method. Now I'm going to discuss full goodwill method with you guys. CR means consolidated retained earning. Innocent students. CR means consolidated retained earning. I have a request to all of you that please don't leave the class and join again. Don't leave and join again, because if you leave, you will enter in a waiting room, and for waiting room I have to give permission to you. And there is some problem there is a little problem in my laptop, so I will be disturbed because of you. Okay, so please don't leave the class and join again. Don't do this incoming and outgoing, please. Right now, listen. Just have a minute, wait. Okay, now the second method is full goodwill method. How to calculate impairment of goodwill in full goodwill method? Quick, students, you have, this is acquisition date, this is acquisition date, and this is reporting date. Okay, now once again we are saying P company has 80% holding in S company, but it's a full goodwill method. So in the full goodwill method, the goodwill computation is like COI. And once again, now we'll add fair value of NCI at acquisition because we need to calculate 100% goodwill. Now, this is your acquisition date net asset packet. So we'll use in the calculation of goodwill. So this will give you a 20,000 goodwill. Okay. Now, what happens at the end of year end? At the end of year end, you need to do impairment testing. So what's your net asset packet? Your net assets packet at the year end is 60,000. Now the question is, sir, are you using complete net assets? Yes. Now there is no need to multiply it by 80%. Now there is no need to multiply it by 80% because everything is 100% now. Goodwill itself is 100% now. Okay. Now, as I've picked this 60,000 from S company's individual books, so that's why goodwill has not already been added. Goodwill has not already been added. So we need to add goodwill. What's the goodwill? Goodwill is 20,000. So this makes 60 plus 20, 80. Okay. And this 80,000 is the carrying value of CGU, complete CGU. This 80,000 is the carrying value of complete CGU. Now in the question, you will be given recoverable amount of CGU, which is already 100%. Now you tell me 80,000 is the carrying value and 68,000 is the recoverable amount. So how much carrying value is greater than recoverable amount? So impairment is must. Yes, 12,000 is the impairment. Now, as examiner has not discussed about any particular asset, so definitely the first number is of goodwill. The first number is goodwill number. First number is goodwill. Okay. So this 12,000 will be completely, charged. This 12,000 will be completely charged to goodwill. Okay. So this 12,000 is the pure goodwill impairment. This 12,000 is the pure goodwill impairment. Okay. Now listen. How to make the entry of goodwill impairment now? Listen. In full goodwill method, goodwill is considered to be a complete asset of S company, like plant of S company, like inventory, everything. S company records every asset as a complete asset in normal consolidation. But in full goodwill method, we record complete full goodwill of S company. So now when we book this impairment, this impairment is like S company's expense. This impairment is like S company's expense, and when we book S company's expense, S company's profits will go down, and when S company's profits will go down, S company's post retain earning will go down, and when S company's post retain earning will go down, we'll have effect on two places: CR, consolidated retain earning, and NCI, retain earning and NCI, consolidated retain earning and NCI, consolidated retain earning and NCI. So what will be the entry? See, we'll credit the goodwill by 12,000. Now what's the 12,000 times 80%? It's 9,600 will be debited to CR, and NCI is 2,400. Okay. You got it? Now, one thing I would like to clarify you guys, because sometimes you students also see the exam kit solution. For full goodwill method, my solution and exam kit solution or past paper solution will be same. But students, for proportionate method, I have multiplied the net assets. I have multiplied the net assets, and I have multiplied the net assets, this, and recoverable amount by 80%. And you know what your examiner sometimes does? They convert the goodwill to 100%. And they use the word notional goodwill. So that's a separate method. So if somebody is following that method, that's also correct. That's also correct for proportionate method. But I don't recommend and I don't follow that method. I just convert I just convert net assets and recoverable amount to 80 or 70%. Okay, so that's your choice. You can follow anything. Now, for one thing, I forgot to tell you. There is a WhatsApp group link in the chat box. In the chat box, there is a WhatsApp group link. Kindly join it so that I can give you more material and more latest classes I can send you. Okay, so all of you must join that WhatsApp group link. Okay, it's in the chat box. Thank you. Now, the next thing. Few things we need to discuss now. Be very active, be very active, be very active. And that thing is fair value adjustment. Fair value adjustment. You know, the formula of goodwill is cost of investment, a shortcut formula. Cost of investment less fair value of net assets. Fair value of net assets of S company. So you know, net assets is equal to C is equal to A minus L. This C is net assets. This C is the net asset. This C is the net asset. This C is the net assets. Okay, so you need to bring S companies. You need to bring S companies all assets and liabilities to fair value. You need to bring S companies all assets and liabilities to fair value. Okay, so for that, sometimes the fair value adjustment is given. It's very simple. And the first issue is the fair value adjustment of land. For example, they tell you that land is already recorded at 100, but the fair value of land is 300. Okay, so now just use your brain. You need to bring your land from 100 to 300. So there is upward fair value adjustment. See, upward fair value adjustment of 200. Okay, so when you increase the asset, your net assets will also go up. Okay, so you will write here fair value adjustment land in the net asset packet. Okay, and now open your eyes, listen. And the good news is that you don't have to make complete balance sheet. In SBR last, you can see last 4 years, not a single time examiner gave to make complete statement, SOFP, income statement. No. Okay, so they just ask few adjustment and they just want discussion from you. So listen, if in the question it is written that S company has not yet recorded this fair value adjustment, that means S company does not know about this fair value adjustment. So you need to adjust this fair value adjustment in the reporting date packet as well. You need to adjust this in the reporting date packet as well. But look at here. If in the question sometimes examiner write this thing, that in the post period, S company has recognized this fair value adjustment. So student, look at here. Now you don't need to adjust in this packet. Now you don't need to adjust in this packet. Only acquisition date net asset packet is adjusted. Okay, one more thing. Let's suppose sometimes they ask you for the depreciating asset. Quick, I'm giving you 1 minute revision for depreciating asset. For example, the asset is not land, it's plant. The asset is plant. So the carrying value of plant is 100. Open your eyes. Carrying value of plant is 100 and the fair value of plant is 300. Carrying value is 100 and fair value is 300. So what's the difference? 200. So 200, see, we'll write 200 as upward fair value adjustment. Now we all know that now there is a gap of 2 years. See the gap. This is 1st January 20 is the acquisition date and reporting date is 31st December 21. So there is a 2 years gap. Open your eyes. There is a 2 years gap between the acquisition date and SOFP date. So you know, you need to adjust 2 years depreciation. Of this fair value adjustment. So let us say they are giving you the remaining life as 5 years. So what you do like this. Listen, excess depreciation, look at here, it's 200 divided by 5. 200 divided by 5 years. So you will get per year depreciation. Per year depreciation is 40 times how many years? 2 years. So definitely it's going to be 80. So whatever asset you revalued at the acquisition date, that asset must be depreciated by 80 in the reporting date. So in the reporting, at the reporting date net asset packet, in the reporting date net asset packet, you will only adjust 120. You will only adjust 120. You will only adjust 120. Okay. Now listen. Now listen. Then next issue. It's a 12 months period. See, 12 months period. Acquisition accounting. You know, this thing was not part of your previous F7 course, FR course, but yes, it's the part of SBR and ICAEW course. Listen, what is this thing? You know, sometimes when we acquire, when P company acquires S company, so because of practical reasons, like we can't calculate fair value of some things because market is closed, the staff is busy, or any practical hurdles, right? So IFRS 3 business combination has allowed us 12 months, exact 12 months from the acquisition date, exactly 12 months from the acquisition date, that we can wait next 12 months. If we get the fair value of assets of S company within 12 months, then these new fair values will be considered as fair value adjustment. Then these new fair values will be considered as fair value adjustment. And yes, we need to adjust the acquisition date net asset packet. We need to adjust the acquisition date net asset packet and goodwill and everything. Like it's like a normal fair value adjustment. If you get the fair values, information within 12 months, then it is considered as normal fair value adjustment and normal treatment. What we do, you have to do it. Okay. But yes, if you get the fair value after 12 months, then this will be treated as post period revaluation. Okay. Now, one more very simple topic, very routine topic. I'm sure you all know this. We are just revising it. Revision is also important so that things come up in your mind. You will get the confidence that yes, I know everything. Listen, fair value adjustment liability. You know, this is C is equal to A minus L. So the requirement is net assets should be at fair value, and net asset is the combination of assets and liabilities. Net assets is the combination of assets and liabilities. So just think, if your liability is not at fair value, so definitely your net assets not at fair value. So sometimes you move your liability. Like if you are increasing the value of your liability, so definitely your net assets will go down. If you are increasing the value of your liability, so your net assets will go down. So this is what we call fair value adjustment liability. This is what we call fair value adjustment liability. And there is a topic which we call fair value adjustment contingent liability. Let me show you, please. See this thing. For example, today P company acquired S company. Okay. And when P company acquired S company checked the individual books of S company. P company is just reviewing the individual books of S company. So what P company see in the notes to the accounts, that there is a case on S company, and the outflow chances is just possible. Outflow chances is just possible. So, you know, for possible chances of outflow, IS 37 says only make contingent liability disclosure. IS 37 says only make contingent liability disclosure. IS 37 says only make contingent. IS 37 says only make contingent liability disclosure. Okay. So in individual books, the disclosure is excellent. S companies individual books, this disclosure is excellent. But now listen, what is the requirement of IFRS 3? IFRS 3 says if there is a contingent liability in disclosure in S companies individual books at the date of takeover, so it is the responsibility of parent company accountants to recognize this contingent liability, to recognize this contingent liability if fair value of this liability is available. recognize in this contingent liability, recognize this contingent liability if fair value of liability is possible, if fair value of liability is available and given. Okay, so how you going to do it? Listen, C is equal to A minus L, and in the examination they have given fair value of contingent liability. Fair value of contingent liability is, let us say, 500. Okay, so how you going to do it? Listen, you will give birth to this liability, you will give birth to this liability, this liability will go up, so the net assets will go down. Okay, see 500 and 500. Okay, so obviously in the acquisition date net assets packet, just use your brain, I can't write everything. In the acquisition date net assets packet, this fair value adjustment will be treated as a negative number. This fair value adjustment will be treated as a negative number. Okay, so this is the requirement of IFRS 3. Now one thing, just 1 minute, because this is a paper of theory, and you know you must have stuff to write, you must have stuff to write. So let me give you one excellent logic, one excellent logic, that why IFRS 3, why IFRS 3 is so strict, that for consolidated books IFRS 3 ordered to book to recognize this liability. Let me tell you the logic. Listen, you know, when P company, listen, and you guys must have studied this thing in your FM paper, F9 FM paper, theory book, theory classes, it is included. There is a topic, I forgot the name, business valuation. Yes, business valuation. There is a topic name, the name of that topic is business valuation. So you know, when parent company buys S company, so parent company checks each and everything of S company. Parent company is not blind and deaf, parent company can see. So just think, parent company is buying a company with case on it, parent company is buying S company with case on it. Okay, so definitely parent company will pay less price, parent company will pay less price. So there will the impact of this contingent liability is in the COI already, is in the price, it's the impact is already included in the price. So standard says when this contingent liability has affected this price, so it must affect this net asset as well. So there is a correct goodwill. So the comparison with it should be like with like. So the comparison should be like with like. Comparison should be like with like. Okay, that's why you need to take impact. That's why you need to take impact of this in the fair value of net asset. You need to take impact of this in fair value of net assets. Okay, this is the requirement. Don't forget it. This may come. It comes. Now, there is a topic which we call deferred tax on fair value adjustment. There was a time when this paper was P2 paper, because I've been teaching since almost last 12 years. So there was a time when it was a P2 paper. So in P2 paper, this examiner tested this adjustment 2 or 3 times, I remember. Okay, but now recently they haven't tested this. So maybe possible it may come, because SBR course is like big course, so anything may come. So we must have knowledge of everything, little knowledge. Okay, you hope you remember my words, golden words, I must say. Breadth is important than depth. In this course, in this paper, breadth is important. Keep little knowledge of everything. Tuk, 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 tuk. Keep things in your mind. Okay, right? Now, deferred tax on fair value adjustment and future depreciation. I hope you remember when you study IS 12, your teacher, all teachers teaches a topic, deferred tax on revaluation, remember? And they teach the entry revaluation reserve debit and deferred tax liability credit, revaluation reserve debit and deferred tax liability credit. Okay, so this is the same topic. Listen, let me start. This is your C is equal to A minus L. For example, this packet, this is acquisition date, net assets, and this is reporting date, net assets. This is acquisition date, net assets, and this is reporting date, net assets. This is reporting date, net assets packet. Okay, now what is going on? Listen, at the date of acquisition, we have a plant which has a carrying value of 5,000 and fair value of 15,000. Okay, there is a plant with a carrying value of 5,000 and fair value of 15,000. So quick, tell me, how much is the fair value adjustment? 10,000. 5 to 15, it's 10,000. So asset is going up, so net asset will also go up. So how we'll do it? Listen, we'll adjust 10,000 here. We'll adjust 10,000 here. Okay. And now in this question, there is only 1 year gap. This is 1st January 20 and this is 31st December 20. This is 31st December 20. So there is only 1 year gap. There is only 1 year gap between acquisition date and SOFP date, between acquisition date and SOFP date. Okay. So let us say examiner is saying that depreciation rate is 20%. Depreciation rate is 20%. So now you tell me this 10,000 thing will be depreciated by only 1 year. There is only 1 year. So 10,000 times 20% is, so 10 less 2, you will add 8,000 here. You will add 8,000 here. Okay. Now, very interesting thing. Listen, you know, at the date of acquisition, we just did fair value adjustment. And to be very honest, fair value adjustment is like a revaluation. Fair value adjustment is like a revaluation. Okay. So just think, when this is a revaluation, so you need to book deferred tax on revaluation. I hope you remember it. You must know it. And let me give you a little logic. See, the value went up. The value went up by 10,000. So we went to the tax department. We said, oh, good news, take the tax. Tax department will say, no, we don't want to take tax now. But yes, as the value has increased, so that means you will sell it in the future for expensive price. So yes, we'll charge tax in future. So in this case, we have to pay tax in future. It's a taxable TD. It's a taxable TD of 10,000. So for taxable TDs, we need to book deferred tax liability. For taxable TDs, we need to book deferred tax liability. So my dear student, tell me 10,000 times 30%. 10,000 tax rate is 33%. 10,000 times 30%, there is a 3,000. There is a 3,000 deferred tax liability at the date of acquisition. There is a 3,000 deferred tax liability at the date of acquisition. Now, how to record it? Look at here. As we have not recorded the revaluation at the acquisition date, so the deferred tax liability. So now let's recognize this deferred tax liability at the date of acquisition. So when we record this deferred tax liability at the date of acquisition, your liability will go up and your net asset will go down. Okay. So you will write here 3,000 as a negative number. You will write here 3,000 as a negative, 3,000 as a negative number, 3,000 as a negative number, right? Okay. Now, one more thing. Just think, I will teach you in two styles, whatever style suits you, pick it up. You know why we booked this deferred tax liability? You know why we booked this deferred tax liability? Because the value of assets went up. Because the value of asset went up. That's why we booked this deferred tax liability. So just think, if in future, because of any reason, if the value starts going down, so we need to reverse this deferred tax liability. Then we need to reduce this deferred tax liability. And yes, in future, it is going down because of depreciation. In future, it is going down because of depreciation, right? So with how much speed it's going down? With how much speed it's going down? 20%. See, the depreciation rate is 20%. So just use your brain. 3,000 times 20%. In this 1 year, it will go down by 600. So at the year end, 2,400. At the year end, 2,400 DTL. At the year end, 2,400 DTL. At the year end, 2,400 DTL will be available. So you will write deferred tax on FVA. Okay. So this is how you adjust. This is how you adjust it. Okay. So be careful about it. You got it? Please write your feedback. Yes, you can do. You can do 8,000 times 30%. One student told me this, listen, directly 8,000 times 30% will also give you 2,400. Yes, this is also one. Okay, let's move. I told you guys not to leave the class, because if you leave and you will re-enter, you will be stuck in that waiting room. And you know, there's a little problem with my laptop, so I won't be able to allow you again. There is some hanging issue, right? So be careful, don't leave the class. If you leave and join, you will be stuck. Now, the next thing is fair value adjustment, internally generated brands. Yes, quick theoretical thing. You know, there are some, you know, let's say S company is living a separate life. S company is no more the subsidiary of parent company. S company is living separate life, let us say, just for the example. But now an S company already has internally generated brands. S company has already launched some brands, internally generated brand. And we all know that internally generated brands cannot be capitalized. Internally generated goodwills and internally generated brands cannot be capitalized according to IS 38, right? But now what happened? But now what happens? P company, now what happens? P company acquired S company. Now what happens? P company acquires S company, P company acquires S company, right? So when P company acquired or take over the running business of S company, that simply means P company has bought S company. So now for P company, this brand is purchase brand. For P company, this brand is purchase brand. So yes, parent company can record this brand in the consolidated books. So for the purpose of consolidation, if we have such unrecognized intangibles in the S company's book, so we'll give birth to these intangible assets. We'll record it at fair value, right? Okay, and this is same as fair value adjustment. Use your brain. Okay, there are, yes, consolidation itself is a big C. It's a big C. So I have picked just technical topics, right? So you know, there is a topic which we call types of consideration. There is a topic which we call types of consideration. So types of consideration, we have cash consideration, loan note consideration, shares consideration, deferred consideration, contingent consideration. So I'm just going to discuss a little bit on contingent consideration. You all know that contingent consideration means what if promises, right? Okay, so there is definitely an element of uncertainty in contingent consideration. Now, what the latest IFRS 3 after 2008, there was a revision in 2008 in IFRS 3 business combination. After 2008, IFRS 3 says that record contingent consideration at fair value. IFRS 3 says record contingent consideration at fair value. Okay, but yes, contingent consideration, sometimes it is treated as a liability and sometimes it is treated as equity. Wait, the double entry for contingent consideration is this: debit investment and credit contingent consideration. Okay, open your eyes. Normally this is the same entry for all types of investment debit, deferred consideration credit, investment debit, contingent consideration credit. Okay, now the issue is this credit side is sometime recorded as equity. This credit side is sometime recorded as equity, and this credit side is sometime recorded as liability. Okay, and if you record this credit side as equity, then the future treatment will be different. And if you treat this credit side as a liability, then the future treatment is different. Okay. Now be very active, because I will connect things with accounting standards which you have studied, like financial instrument, like IFRS 2 share-based payment. IFRS 2 share-based payment you have also done. Listen. In case, read it very carefully. In case of if P company promised to pay cash, the first thing is, if parent company has promised to pay cash, then if you promise to pay cash, then it's a liability. Or parent company promised to give variable number of its own shares, variable number. So I'm sure you have studied financial instrument. You all have studied financial instrument. In financial instrument, I always teach, even everybody teaches, that the promise to give variable number of our own shares is a liability. Okay. So if two of these things, if these things are there, cash promise, or if you have promised to pay cash, or if you have promised to pay variable number of your own shares, then this transaction will be a liability. Now, and when it is treated as a liability, now what you do? Then not only at the acquisition date we need to record it at fair value. Yes, at the acquisition date, this is must, that contingent consideration must be recorded at fair value. But now it's a liability. So there is a risk. In liability, there is a risk. So now at each reporting date, you need to revise the fair value. You need to record this liability at fair value, and the changes will be taken to P&L, or you call it retained earning. When it's a balance sheet question, when it's an SOFP question, you take it in retained earning. You take it in retained earning. Okay, right? Giving you example, remember IFRS 2. In IFRS 2, with cash settled share-based payment, when we make liability entry, students, when we make liability entry, so what we do, we need to take the fair value at each year end. We need to take the fair value at each reporting date. Okay, same treatment. Now, if contingent consideration is a promise to deliver fixed number of P company's own shares, Oh, I hope you remember financial instrument. In financial instrument, your teacher has taught you that if any company promised to deliver fixed number of its own shares, then this transaction is recorded as equity from day one. Then this transaction is recorded as equity from day one, right? Okay. Now, then this transaction should be recorded as equity. And in case of equity, we are only required to record contingent consideration at fair value at acquisition date. No more future upgrades, no more fair value upgrades in future. Remember IFRS 2. Let me connect it with IFRS 2. In IFRS 2, in case of equity settled share-based payment, we always use fair value of option at the grant date. Remember this. We always use fair value of option at the grant date. No more future revision of fair value. Remember, same is the case here. In equity, you don't revise the fair value. Just sleep. No tension. Okay. So don't forget this thing. The examiner may ask. This is a technical little issue. Just read it. Quick read. Okay. So now, yes, very interesting topic is coming. Open your eyes. Listen, listen, listen. Different treatment in individual and consolidated books. Different treatment of same items in individual and consolidated books. Different treatment of same items in individual and consolidated books. In individual and consolidated books. Listen. P company, I'm sure this thing I have taught you guys in IS 40, but in quickly I'll tell you. P company rent, listen, let me make this, listen. This is P company, okay? And P company is renting its building to S company. P company giving its building on rent to S company. So now in individual books, just think individual books. In individual books, P company is earning rental income from this property. P company is earning rental income from this property. So obviously in individual books, it's IS 40. Individual books, parent company will apply IS 60. But for the purpose of consolidation, this property is used inside the group, So in the group accounting, we'll record IS 16. In the group accounting, we'll treat it as IS 16. In the group accounting, we'll treat it as IS 16. Okay, this is the first thing, very routine thing. Now, second thing, I remember there was a past paper of 2005. The name of that past paper was J. This was the name, J. Now this past paper is no more in any kit, but I remember back in my days, right? So what happened in that question? P company, listen to me. P company made an agreement with S company before the year end. It was a perfect agreement that yes, we'll sell this non-current asset to you after 15 days of the year end. P company will sell its non-current asset to S company 15 days after the year end. Look at me. So it was confirmed in the individual books. It was confirmed that P company will sell this non-current asset to S company. So yes, in the individual books, IFRS 5, non-current asset held for sale. In the individual books, we'll do the accounting of held for sale, and this asset will be recorded as a current asset. This asset will be recorded as a current asset in P company's individual books. This asset will be recorded as a current asset in P company's individual books. And there is no depreciation in P company's individual books from the date it is classified as held for sale. Okay, right? Now, plus there are some impairment implications as well. I know, we all know this of IFRS 5. This impairment implication will also be done in the individual books, in the individual books of IFRS of parent company. But now just think about the consolidated books. For consolidation purpose, this group is single unit. This whole group is single unit. Just think. So that means I'm selling the plant to me. I'm selling the non-current asset to me. If parent company is selling goods to S company, parent company is selling non-current assets to S company, that means it's within the body. So this sale is not a sale. This sale is not a sale at all. And the asset will still be used inside the group. So now open your eyes. This was a practical question, came in the exam. Now dear student, for the purpose of consolidation, listen. For the purpose of consolidation, listen. For the purpose of consolidation, we'll record it as IS 16. We will record it as IS 16. So in individual books, we record it as current asset. So first of all, we need to convert it from current to non-current asset. Then we have to book depreciation, which which was not booked by P company, we need to book that depreciation. Okay, so that was a very interesting question, just giving you a hint of that question. Okay, did you get it? Please write. Did you get it? Please write on the chat box. Okay, next, P company buying goods. P company buying goods. I again repeat, please don't leave the class because it's very difficult for me to rejoin you. See, I have to use different keys now. My mouse is not working properly, please. Now, the third thing is P company buying goods from S company in future for fixed price. This is about hedge accounting. You know, if I give you a quick 1 second review, you know, the conditions of hedge accounting. If you want to do hedge accounting in your books, there is a big condition. You must have to prove risk. You know, hedging is about minimizing risk. Hedging is about minimizing risk, controlling risk, right? So until and unless you prove that you have a risk in your book, your auditor won't allow you the hedge accounting. So for hedge accounting, the first condition is that you have to prove, yes, you are facing this risk. Okay, so now listen. Wait. For example, me and my elder brother, Sir Subhan Mirchawala, giving you a quick example. Me and my elder brother, Sir Subhan Mirchawala, we are watching a match between Pakistan and India. Okay, cricket match. Okay, now, you know, Sir Subhan has bet on India. We had a bet between both of us, and Sir Subhan bet on the India win, and I bet on the Pakistan win. This is a bet between Sir Subhan and me. So yes, in the individual books of Sir Subhan, there is a risk. In the individual books of Sir Mustafa, there is a risk. But in the family books, there is no risk. In the family books, there is no risk. Obviously, because in the end, one company will win, another team will lose. So if Pakistan lose, that means Sir Subhan will get the money, I'll lose the money. Overall, there is no impact on the family wealth, right? So in the individual books, we are allowed to do hedge accounting here, but in the consolidated books, we are not allowed to do hedge accounting. I'm sure you got the example. Very simple example. You listen to me. I've made this example here. P company buying goods from S company in future for fixed price. For example, P company has done contract with S company that will buy sugar for $2 per kg in future, for fixed price $2 per kg in future. P company has entered this agreement with S company. So now, if in the end the prices will go up, then P company will win and S company will lose. S company will have a loss and P company will have a gain. And if the prices goes down, P company will be on the loser side and S company will be on the winner side. So yes, in the individual books, they have the risk. In the individual books, they have the risk, but in the consolidated books, they don't have any risk. So in the consolidated books, they are not allowed to do hedge accounting. In the consolidated books, they are not allowed to do hedge accounting. Okay. Now, the fourth thing which I've already taught you, the contingent liability issue. Remember, at the date of acquisition, if there is a contingent liability, in S company's individual books, so we need to record this contingent liability in the consolidated books. I've already discussed this. Now, the fifth thing, technical issue. Please be careful. Investment in subsidiaries. You know, when parent company buys shares of S company, let us say 80% or 90%, in the individual books, we write it as an investment in subsidiary. In the individual books, we write it on the asset side and we use the word investment in subsidiary. Now look at here. in the individual books, you have multiple options available. In the F7 level, remember you used to record that investment at cost, original amount for which you have bought. Till the F7 level, you used to record that investment at cost. You used to record that investment at cost. Remember? Now, there is one more option. You can apply IFRS 9 on that investment, and both categories are allowed, fair value through P&L and fair value through OCI. And one more thing, you can apply equity accounting as well in the individual books. Okay, so in the individual books, all these things allowed. But in the consolidated books, remember, in the consolidated books with subsidiaries, you cancel all investment and you completely do adding together. You compute goodwill, you compute CR, you compute NCI. So there are, students, many things. There are many things. There are many things which you do in the consolidated books, right? So in the consolidated books, this investment is eliminated. Now, very crucial issue. It is also written in your study text as well. Listen, for consolidated books, we need to bring investment in subsidiaries at its fair value of acquisition date. Listen. For example, listen. This is your acquisition date, 1st June 2021. And right now, the fair value of investment is 150. Okay. The fair value of your COI, investment means COI, cost, is 150. And let us say in the individual books, you are using fair value through P&L. In the individual books, you are using fair value through P&L. This is a technical issue. Please be very active. So let us say at the year end, the fair value is 200. Okay. So in the individual books, you book this gain of 50. In the individual books, you book this gain of 50, right? In the individual books, you book this gain of 50, but for the consolidated books, you need to reverse this gain of 50 for the consolidated books, and you need to bring the investment at this value at the date of acquisition. Did you understand this point number 5? This was the most technical point of today's class, I think. That all future fair value change, you need to reverse if you have booked at fair value through P&L or fair value through OCI. Listen here, I repeat. In the consolidated books, students, in the individual books, you have all these options: cost, fair value, everything. For example, you are using the fair value option. And this is your acquisition date. So for the purpose of consolidation, you need to bring this investment at its fair value of acquisition date. So for example, if you have done further revaluation in individual books like this, see this 50, there will be entry investment debit 50. You have made this entry, see, investment debit 50 and P&L credit 50. So if you have booked any further revaluation in the individual books, so now you need to reverse this. To acquisition date. And why this is happening? Otherwise, there will be double counting. Because individual books also impacts the consolidated books. We add together. So if there is an extra gain in individual books, that will come in the consolidated books as well. Because now in the consolidated books, we are adding together S company from top to bottom. We are adding everything of S company. So now there is no need of such accounting. So definitely you need to reverse it. Otherwise, there will be double counting. It's a technical issue. Now, there is a topic which you have done, step acquisition. Please don't sleep. These are last days. Sleeping not allowed. Take tea if you are sleepy. Listen, step acquisition. step acquisition means gradually you are buying shares. So there is one case, I means trade investment, like 10% to 30, 30 to 80, and this is 10 to 80. Okay, just look at here. If you see these three cases, use your brain. If you see these three cases, there is one thing which is common, the change in status. I to A means, I means trade investment means no significant influence, no control. But if you are going from I to A, yes, there is a status change. Yes, there is a status change. Now you are getting significant influence. Similarly, second case, A to S, again, there is a status change, status change. I to S, again, status change. Don't, this is the recognition thing, status change. Now, in all these three cases, there is a change in status. That's why you need to bring, existing investment to fair value at the date of change in status with gain or loss in P&L, like, and you know what's the logic? The logic is like, listen, in my normal classes, I use the word small car and big car. It's like you are moving from small status to big status. So just think in your mind that you are selling your small car. You are selling your small status car, and you are buying a new big status car. So it's like selling of old car and buying of new car. So when you sell your old car, you sell it at fair value. You sell your own old car, you sell it at fair value. So there's obviously a gain or loss on disposal. So that's why in short, you need to bring your existing investment at fair value. Fair value. This is the requirement. Don't forget. Let me give you number crunching as well. Now listen, I to A. Listen, for example, on 1st of January 08, please students be active. On 1st of January 08, you bought 10% shares for 10. Okay, you bought 10% shares for 10. Now, and 10% means only trade investment, no significant influence. Now, on this date, after a year, on this date, you bought 20% more shares. So this is the case of I to A. You got significant influence now, and you got new shares for 20. So what is the requirement of standard? You need to bring this, you need to bring this existing investment to fair value with changes taken to P&L. So from 10 to 12, you need to make one entry, investment debit to, investment debit to and P&L credit to. Okay, so you need to make this entry. If this entry has not already been made, this is also a condition. You need to bring the existing investment to fair value. If examiner has already not brought this existing investment to fair value, then you have to make this entry. Okay, be careful, don't sleep. And if it's a balance, if it is SOFP question, then investment debit and retained earning, consolidated retained earning credit, investment debit and consolidated retained earning credit. Okay, now from this date onwards, you got the significant influence. From this date onwards, you got the significant influence. So from this date onwards, you have to do equity accounting. From this date onwards you have to do equity accounting. There is a question, so one student is asking, sir, this fair value of existing investment is it will be given? Yes, it will be given in the question. All past papers says that it is given in the question. Okay, now from now onwards what you do, you have 30% holding. Okay, so fair value of existing small car is 10%. This is the one price, and the new 20% shares you bought for 20. So your total COI of 30% is 32. The total value of your COI is 32. And now obviously we all know the equity accounting. From now onwards, you will add post profits of a company times 30%. And this is how you will get carrying value of investment in associate. Carrying value of investment in associate. Now, the second case is A to S, quick. A to S is again change in status, same case. Listen, or sorry, let's make it I to S first, I to S. So we bought 10% shares, for 15. After a year, 10% means it's trade investment, right? After a year, we bought 60% more shares. So yes, on this date, we got the control. On this date, we got the control, we crossed the line, okay? So now we need to bring the existing investment again to fair value. So from 15, the existing investment was bought for 15, and now the fair value is 20. So you will be making one entry, debit investment 5 and credit P&L 5, debit investment 5 and credit P&L 5. Okay, you need to make this entry. Now, you know, this is the question of consolidation. Now I to S, S means subsidiary. Now you are getting the control. Now students, we are getting the control, so we need to do consolidation accounting, and in acquisition accounting we need to calculate goodwill. In acquisition accounting we need to calculate goodwill. We need to compute goodwill. Students, look at here. Now, how do we calculate goodwill? Let us say, for example, it's full goodwill method. Just for your, it's a full goodwill method. Okay, so now we have all, we just bought 60% shares. We just bought 60% shares. See, this is 60%, and the fair value of this existing investment 10%. So 60 and 10 is 70%. This is the 70% price already here. And now if it's a full goodwill method, students, so you will be given fair value of NCI, which is 30%. So automatically, if you add these three, if you add these three, it's 100%. So less fair value of net asset, which is already 100%. So automatically you will get the goodwill. You will get the goodwill. Okay, now the third case is A to S. It's almost similar. I'm telling you, just a formality. Listen, for example, now A to S, you already bought 25% shares. From day one, you have significant influence. Okay, now, and your COI is 100. When you have significant influence from day one, so you need to do equity accounting from day one. Okay, now, so for example, COI is 100. In equity accounting, I'm giving you a shortcut now. We are running short of time. Okay, we are in revision days, not normal classes. So let us say with this COI, you will adjust the post profit. You will adjust the post profit, and after adjusting post profit, see this. After adjusting post profit at the end of year one, your carrying value of investment in associate is 115. That means 15 is the post profit share. That means 15 is the post profit share of a company. Okay, I have given you ready-made. This year carrying value of net investment in associate at the end of year one. Now, on this date, you bought new 50% shares. So you already had 25%. You already had 25% and you just bought 50% more. So 25 plus 50, you got the control. You crossed the line. You crossed the line, right? So now, and you bought these new shares for 200. You bought these new shares for 200. You bought these new shares for 200. Okay. So now, first of all, you need to bring this existing small car to fair value. You need to bring this existing small car to fair value. What is the carrying value of this small car? What is the carrying value? Student, look at here. The carrying value of this small car is 115. The carrying value of this small car, the existing investment is 115. And the fair value is 128. So from 115 to 128, how much is the upside? I think 13. From 115 to 128, how much is the upside? It's 13. So first you will make this entry. Look at here. Look at here. Debit investment 13 and credit P&L 13. Debit investment 13 and credit P&L 13. Debit investment 13 and credit P&L 13. Okay. Now, after this, the whole journey is same. Listen, from 1st January 21, obviously, when you got the control, so you have to start the consolidation accounting. You have to start the control consolidation accounting. And for control consolidation accounting, the first thing is goodwill. Okay, let's see. These two, you have 75% shares. You bought 50% shares for 200, and the fair value of small car is 128. So these two makes up 75%. And now if it is a full goodwill method, then fair value of NCI will be 25%. So again, it's 100%. This is also 100%. So you will get the goodwill of 100%. Getting? Got it? Now the third case is sub to sub. Yes, this is one of the favorite case of examiners. Sub to sub means already we had 60% shares and now we got 80%. Now we bought 20% more shares. So already we had control, and after buying 20% shares, still we have control. So now read these words. These are very famous words. No change in control. In economic reality, this is the transaction between equity owners. There is no change in control. In economic reality, it's like partnership sharing ratio. Change in partnership profit sharing ratio, but no change in control. No change in control. Okay. So when there is no change in control, that means no change in status. Remember, in the first three cases, what was important about the first three cases? What the important thing about the first three cases was the change of status. So whenever there is a change in status, things goes in P&L. Whenever there is a change in status, then we take things change, fair value change in P&L. As now there is no change in the status, so nothing will go in the P&L. Be careful. Now for sub to sub, see, we already had 60%. We had 60% shares. So when we had 60%, the NCI was at 40. The NCI was at 40. And now we bought 80. So we pushed NCI back. So now NCI is at 20. Now NCI is at 20. So there is a reduction in NCI. Open your eyes. There is a reduction in NCI. There is a reduction in NCI. Now you need to calculate. You need to calculate students, you need to calculate decrease in NCI. You need to calculate decrease in NCI. Now, I'm just giving you a short advice here. In sub, this sub to sub comes in two areas. It comes in step acquisition as well as in disposal. This sub to sub not only comes in step acquisition, but it is also part of disposal. So I normally give one technique. I normally advises my student one thing. Whenever you find the case of sub to sub, just think about one thing. Who is seller? Who is selling shares? Who is selling shares? So now in this case, NCI is the seller. Parent company is buying shares. NCI is selling shares. So now you need to calculate. Decrease in NCI from the NCI point of view. You need to calculate decrease in NCI from NCI point of view. Let me give you the idea. I can just give you the idea here. First, calculate NCI at 40%. First, calculate NCI at 40% at the date of this change. Calculate NCI using 40% rate just before 1 minute. And then after 1 minute, calculate NCI at 20%. Calculate NCI at 20%. Calculate NCI at 20%. Calculate NCI at 20%. You will find the difference, the decrease in NCI. Okay. And now what's the entry for NCI? What's the entry? Listen, as parent company is buying shares, so parent company is giving cash. So bank credit. And I just told you that in this question, you will have a decrease in NCI. So NCI is the part of equity. So when NCI goes down, we debit the NCI. When NCI goes down, we debit the NCI. Okay. So NCI debit, bank credit. And if there is a difference on the credit side, you will write other equity here, just other equity or other reserve balancing figure, or it may come on the debit side. It depends. Okay. So this is the entry. Students. This is the entry. Just have a look. Please. Again, I'm telling you, this is not a normal class. These are revision days. So there is a time restriction. Please try to understand this issue also. Okay. Still, I'm saying everything 2 times, but there is a time constraint. Now, there is a topic which we call disposal. Listen, in disposal, see the first 4 cases. In these first 4 cases, there is a change in status. In these, right? Just think, we have 80% shares and we sold out all. We had 80% shares, we sold out all. That means we lost the control in just one shot. So yes, this is again change in status. 80 to 30 again. We had control, but now we just have significant influence. This is also just change in status. You sold your control. 80 to 10. You had control, but now you have only, it's your trade investment. Again, you sold out. In first 3 cases, you sold out your control. So it's a change in status. In the 4th case, again, there's a change in status. You had 30% shares and now you only have 10%. So from significant influence to trade investment. So in all these 4 cases, my dear innocent students, you had a change in status. So whenever there is, in all these cases, I'm just giving you, There is a change. That's why gain or loss. That's why gain or loss on disposal must be booked in P&L. That's why gain or loss on disposal must be booked in P&L. Now, let me teach you through the first case. I'll explain you. Don't worry. Just show little attention. See, let us say we are doing the first case. We are doing the first case, and this is the takeover date, and this is the disposal date. For example, this is the disposal date. Now, wait. We originally bought 80% shares of S company. So we got the control, let us say 2 years back. And now on this date, we are selling away all these shares in one shot, 80% shares. Okay. So that means in return, we are getting the DP, disposal proceed. We are getting the proceed. So first of all, you have to write the DP. And obviously, we sold all shares. So this DP is equal to 80%. Now, look at me. Just imagine that you didn't sell the shares, you sold the whole business because you had control. You think like that. You had control of that business. So you sold the control. So you sold the complete company. Okay. So now you need to compute gain or loss. How? Let's see this. Fair value of net assets of S company at which date? Look at the date. At disposal date. First of all, you need to write the fair value of net assets of S company at disposal date because you sold the complete company. Okay. Also, when you sold the running business, use your common sense, use your brain. When you sold the running business, you sold the goodwill as well. You sold the goodwill as well. So you need to write the goodwill at disposal date. Okay. Now these two, you will add these two, but there is a problem. This is also 100%. This is also 100%. So this should also be at 100%. These three are 100%, but this thing, open your eyes. This is 80%. So you can't compare 80 with 100. You can't compare 80 with 100. So you need to remove NCI from this 100%. So look at here, less NCI, look at my words, at disposal date. Again, I'm using the word disposal date, everything. So when you remove NCI, which is 20% at disposal date, so now this thing, look at here, this thing less this thing will give you automatically 80%. So you will have a gain or loss. Gain or loss on disposal. Okay. So those students who like this statement, they can follow it. Those students who like this statement, they can follow this statement. And those who love entry, like me, I like this topic with double entry more. So let me show you the double entry of this as well. Sometime examiner ask as well. Now listen, and definitely one more thing, this NCI at disposal date, it depends on your method. In the proportionate method, you compute NCI at disposal date using the proportionate method accounting. In full goodwill method, use the fair value of NCI and post retained earning accounting. You better know this. Now, how to make the entry for this? So first of all, when you sold the running business, you got the cash. So bank debit 80%. Okay. Now listen to me. I always say in my class that disposal of a subsidiary means you are going to destroy the whole building of consolidation. You are going to break the whole building of consolidation. Okay. So just think, just before 1 second you had the control, and now you sold it. Now you sold all the control. In just one go. So you will say bye bye to S company's net assets. You will just say bye bye to this S company's net assets, and just think, when you sold the running business, you sold the goodwill as well, so you will credit the goodwill, you will say bye bye to goodwill as well. Now when you destroyed this consolidation building, so you need to remove NCI as well. Remember, when we start consolidation accounting, we give birth to NCI. So now we need to kill to NCI. And you know, NCI is the part of equity. NCI is the part of equity. So in order to reduce NCI, we debit it. So you will debit the NCI. Listen. And finally, if there is a gain on disposal, it will come as a balancing figure here. Gain on disposal here, balancing. And if it is a loss, it will come here, loss on disposal. Okay, so this is the entry. This is the entry for the first case when you are selling complete 100% company in one shot. When you are selling complete 100% in one shot. There is a question, quick. How you treat this disposal in individual books? It's like disposal of shares. It's like IFRS 9 disposal of shares. You are selling shares. So investment credit, bank debit, and if there's any difference, you just book the gain or loss in individual books. Now the second case, for example, you are going from 80 to 30. For example, you are going from 80 to 30. Now you had 80%, you had a big car, and now you are coming to small car. Big car to small car. Listen. So now, first of all, from 80 to 50%, that means your proceeds will be equal to 50%. Your disposal proceed will be equal to 50%. Please don't sleep. So now when you sold your big car, the control, in return you receive some cash. In return you receive some cash and a small car. In return you receive some cash and a small car. So you need to bring that small car to fair value. That means you will add fair value of remaining investment, which is 30%. This will be given to you in the question. Remaining everything will be same. Remaining everything. See now, 50 plus 30 is 80. 50 plus 30 is 80. 50 plus 30 is 80, right? 50 plus 30 is 80. Now this all 100%, and then you deduct this 20%, you will get 80. The rest thing is same. The rest of things are same. I'm sure you know this. Just think over it. Now, how to make the entry? The entry will be same, just one change. Now, the bank is 50%. Bank is 50%. And this time when you sold the control, in return, you got two things. Use your brain. In return, you got two things. The first thing is cash, which is equal to 50%. And the second thing, you got the small car. Which is investment in associate. Investment, and investment is your asset. So you will write investment in associate, okay, on the debit side, which is equal to 30%. Okay, the rest of entry remains same. The rest of entry remains same. Okay, I'm sure you know this. And same. Now, one last thing. From now onwards, you lost the control. From this date, you lost the control. From now onwards, you have to do equity accounting. From now onwards, in this second case, you have to do equity accounting. I'm sure you know what is equity accounting. Okay, now for these first three cases, listen my advice, students. Look at here. I'm giving you one tip. One tip for these first three cases. For these first three cases, one tip, and even this we teach, in F7 as well. Teachers teach this thing in F7 paper as well, because some disposal in F7 as well now. Look at here. Important point. In first three cases, include post retained earning of S company in consolidated retained earning till the date you have control. Listen, for example, this is the date 1st January 20, you bought the S company. On 1st of January 20, you got the control. Okay. And this date you sold the control. Listen the word, you sold the control. This date you got the control. This date you sold the control. Okay. This date you got the control. This date you sold the control. Okay. So, and this is your year end. This is your year end. Now tell me which post retained earning you should include. Which post retained earning you should include. Which post retained earning you should include. Tell me. From this date to this date, this is your time. This is your time. This time you controlled the company. Okay. So S company's post retained earning, which you should include in the consolidated reserve, is 250. This area you don't control. This area you don't control. So you have to ignore this 400 to 500 journey. From 400 to 500, this is not your time. You're not the king. You are not controlling S company after 30th June 21. So be careful. Don't do this mistake. Now, this case, now I'm going to open a real past paper in front of you. This 30 to 10, it came in real past paper. Listen, students, in September 2018, when it was the first attempt of SBR. SBR, the first time they launched SBR paper was September 2018. And this thing came in September 2018. So let me give you first my quick. But one thing is there. See, there is a 30 to 10. Again, there is a change in status. This thing is common in all these cases. So let me teach you my topic. Then you can do the past paper quick. Listen. What is this? You had. This is A to I. On 1st January 20. On 1st January 20, you bought 25%. See this, you bought 25% shares of this associate company, and the COI was 500. Okay, COI was 500. Look at here. At this date, net assets of a company, net assets, you call it retained earning. Net assets means equity packet, or you call it retained earning, it was 1000. Now, after 6 months, or like on 1st July 21, like 1.5 years, after 1.5 year, you sold 15% shares. Out of 25%, you sold 15% shares. So now again, from big car, you are coming to small car. From big car, you are coming to small car. Now, student, be very careful. Be very careful. First of all, you need to calculate the carrying value of your investment. First of all, you need to calculate the carrying value of your investment till this date, till this disposal date. Okay. And in this whole journey, you need to apply equity accounting. I'm sure you guys know what equity accounting is. Wait, let me tell you. You will write COI. What is COI? This is the COI. COI is 500. Add post profits of a company. Post profits of a company is how much? 1000 and 3000. See the net assets. 1000 and 3000. It's 2000 times your holding percentage, which is 25%. So again, it's coming 500. So carrying value of investment in associate at 1st July 21 is 1000. Okay, this is the carrying value. Look at, have a look, students, have a look. Have a look now. Simple things, please, simple things. Let me calculate the gain. First of all, you had 25% shares. That means you had a big car. You sold 15%. So you receive, see this, you receive cash 15%. So first of all, you will write DP, which is 15%. And how much is this? 780. 780 is the DP. And in return, you got the small car as well. In return, you got, now you have 10% holding, which is a small car. See, so what is the fair value of this small car? What is the fair value of this small car? The fair value of remaining investment is 600. This is the real. See, these two things, 780 plus 600 is how much? 780. This is your 10%. Okay, so 780, it's 1380. This is the real selling price you got of 25% share. Now less what you sold, less, see this carrying value of investment at this date. This was 1000. So finally you got a gain. Finally you got a gain of 380. You got a gain on disposal of 380. You got a gain on disposal of 380. You know, I can teach you this whole thing with double entry as well, and I'm going to give you double entry as well. I'm gonna give you double entry as well. Just have a look. Just have a look. Okay, let me make the double entry. Wait, this is the entry. This is the entry. You got the money, bank debit, how much? 780. You got this investment, small car investment, which is a small car, 600. It's 10%. Okay. And you said bye to carrying value of investment in associate. So investment in associate credit, which is 1000. So automatically you will get a gain on disposal. You will get a gain on disposal of 380. Okay, this is your double entry. And now for your information, what will happen from now onwards? This is a question. What will, now you are at I. See, the name of this case was A to I. The name of this case was A to I. Look at the screen, my dear students. A to I. So now you are at trade investment. And on trade investment you apply IFRS 9. And with IFRS 9 you have two options. The first one is fair value through P&L, and the other one is fair value through OCI. The first one is fair value through P&L, and the other one is fair value through OCI. Remember, so if you opt fair value through P&L, then future changes will go in P&L. Future changes of fair value will go in P&L. And if you go for fair value through OCI, then the future changes will go in OCI. Now, quick, you have 4 to 5 minutes. This is the real past paper. This is a real past paper of September 2018 attempt. And whatever I taught you right now, this is the same past paper. This is the same past paper. You have max 4 to 5 minutes. No need to write any theory right now. Just do the practical part. But in the exam, you need to write the theory as well. And in my normal class, I have taught you this. I've taught this past paper. It's in my learning management system. I have taught this past paper in my normal routine class. Okay. So my students already, those who really watch the classes, with due respect, those who really watch the classes, it's in my normal learning management system. Okay. But still try it. Give a 5 minutes, give a 5 minute to this. You have just 5 minutes. You have 5 minutes, please. Quick, do it. Did you try? Have you done? Yes, good. Because I just taught you, and there is a possibility that they did wrong in the question. Original treatment, maybe you have to challenge sometimes. Sometimes you have to challenge the original decision. Sometimes you have to challenge the original decision of examiner. Now, listen, Banana had purchased a 40% equity weight. So 40% means you have significant influence. Originally you have significant influence, right? Now for 18 million, this is your original COI number of years ago, and the net assets of A company at that time was 44 million. Since acquisition, Banana had the right to appoint. See, right to appoint means they have significant influence. One of the 5 directors. Yes, we had significant influence. We had significant influence. That's why we have to do equity accounting. You know these things. Now, the next thing is the investment has always been equity accounted for in the consolidated financial statements of Banana. Banana disposed of, see, this is very technical English, 75% of its 40%. 75% of 40%, you know, just 40 times 75% means he sold 30%. That means from 40 to 30, from 40 to 10. Now, our previous holding was 40%, and now we sold away 75% of 40. Just use the technical, see the technicality. We sold the 75% of 40, so it's now we are at 10%. Okay, so it's A to I. And how much we got it? 19 million in return. When the fair value of the identifier, see, now the fair value is 50. Now the fair value is 50. Fair value is 50. Now the fair value is 50. A fair value of net assets. So can you tell me, the previous fair value of net asset at the date of acquisition was 44 and now it's 50. So what is the post retain earning? What is the post retain earning of A company? Can anybody tell me? It's 6 million. So no, it's 6 million. Post retain earning of A company, post net assets of A company is 6 million. Okay, now wait. First of all, let's calculate the carrying value of investment in associate like I taught you. Listen, first of all, you write COI. How much is the COI? 18. COI is 18. Add post net assets of A company. Okay, this is 50 minus 44, which is 6 million, times your 40% holding, which is 2.4. So 18 plus 2.4 is 20. Carrying value of investment in associate. Carrying value of investment in associate. Please, these are very basic thing. I just taught you the copy paste thing. My innocent students, I just taught you the copy paste. There is, you don't have any option to do mistake now. Now, finally, how much, what, let's do it with double entry. Let's do it. How much bank we got? We got the cash of, see, the bank is 19. The bank is 19. What is the small car? See, the fair value of the remaining 10% equity was 4.5 million at disposal, but only 4 million. Leave this, leave it. This thing is leave it right now, leave it. So remaining investment is 4.5. okay, now see, this bank is 30%, this is 10%. okay, so this make 40% on the debit side. And now you will say bye bye to carrying value. See, you will say goodbye to investment in associate. What is this? 20.4. so automatically you will get a gain on disposal. Automatically you will get a gain on disposal, which is to be booked in P&L. How much is the gain on disposal? Tell me. 3.1. 3.1. This will go in P&L. okay, this will go in P&L. This is the correct accounting. This is the correct accounting. This is the correct accounting. But these stupid people, what they did, they booked a loss of 14 million in the reserve. They book a loss of 14 million, which is totally wrong, which needs to be reversed, okay. No, if there is a question, do we have to give this double entry in the exam? No, it's optional. But yes, if the examiner has asked you the double entry, then it's compulsory. Otherwise, it's your option. You can do in the form of a statement, you can do in the form of double entry, both things are allowed. But if examiner is asking double entry, then you have to make. Okay, then you don't have any option. Then you don't have any option, students. Getting my point? Now, the next thing is what they are saying. Banana has stated that they have no intention to sell the remaining shares in Strawberry. That means they want to hold. They want to hold long term. Okay, long term means fair value through OCI, and wish to classify the remaining 10% as fair value through other comprehensive income. Okay, so this 4.5 and in the future it's 4 million. The future fair value is 4 million. So now from now onwards, you have to make this entry for future. OCI debit, which is 0.5, and investment credit 0.5. Did you understand, students? Students, did you understand? Please tell me. Believe me that everything is confidence. Please be confident now. Study in a good mood. Treat yourself as a winner. Treat yourself as a winner. You know, the positive time thing for this paper is the passing rate. It has got almost highest passing rate in all professional exams, almost, which is close to 50, 48, like this. So it's a very good pass rate. Yes, you need, if you want to make the entry, yes, you can make the entry, or you need to write it for, otherwise write in the theory. You need to discuss. The theoretical discussion is important according to the requirement. Okay, now the last thing, there's a case of sub to sub. There is a case of sub to sub. There is a case of sub to sub, students, 80 to 60. Now 80 to 60 means previously we were at 80%, so NCI was at 20, and now we sold 20% shares, so NCI is at 60. Sorry, now we sold 20, so we are at 60, so NCI is at 40. Okay, so in this transaction, again, this is not difficult now because I've already taught you. Again, we say it's no change in control. Previously we had control, now still we have control. Okay, this is compute increase in NCI, because NCI is going from 20 to 40. NCI is going from 20 to 40. Now listen, dear student, just 5 more minutes I'll take. Just 5 more minutes, please. Sorry, 5 more minutes. I just want your 5 minutes, please. In sub to sub accounting, what I taught you, always find out who is selling shares. Always find out who is gonna sell shares. And now in disposal sub to sub, parent company is selling shares. In disposal sub to sub, parent company is selling shares. Parent company is selling shares. So now you need to calculate increase. You need to calculate increase in NCI from parent company point of view. Now look at me. Just think. See this circle. Parent company holds. Parent company has control over complete S company. Parent company has control over complete S company. So you will write fair value of net assets of S company today. Net means now at disposal date. Fair value of net assets of S company today means now, right? And my dear student, if you are using full goodwill method, if in the question it is written that you are using full goodwill method, you know, in full goodwill method, NCI has given, we give share of goodwill to NCI as well. In full goodwill method, we give share of goodwill to NCI as well. So you will add goodwill of this date. So now this is complete fair value with goodwill of this company. and you just gave away 20% shares. So you will multiply it by 20%, you will get increase in NCI. You will get this number, increase in NCI. Please see this. Please see this. Think over it. Think over it. Please think over it. Think over it. And I repeat, whenever you get the case of sub to sub, always think about it. Who is selling shares? Who is selling shares? And in this case, the seller is parent company. So we have to work from parent company point of view. In the previous sub to sub of step acquisition, NCI was seller. NCI was seller. So we were working from NCI point of view. Now, just one question. Yes, one student has asked one question. Please let me give answer. Sir, what if this question is of proportionate method? Then you need to listen, look at here. Then you need to skip this part. Then no need to add goodwill. Then no need to add this goodwill. Only fair value of net assets. Okay. If it is a proportionate method. One very comedy question. What happens when seller is not parent? Then this will be not a disposal case. Then it will be a step acquisition case. Step acquisition case, not disposal. In disposal, parent company is always seller. In disposal, sub to sub, parent company is always a seller, my dear student. So now see, if it was a proportionate method question, then no need to include goodwill. No need to goodwill. No need to include goodwill. Okay. Okay, now what will be the entry for this? Obviously, parent company is selling shares, so parent company is receiving the price, so we'll debit the bank. And in this case, you can see NCI is increasing. You can see NCI is increasing, so you will credit the NCI. And now if there is a balancing figure on the credit side, so you will write other equity credit, nothing in P&L, okay? And if it's on the debit side, you will do other equity or other reserve on the debit side. Other equity or other reserve on the debit side. Other equity or other reserve on the debit side. On the debit side, okay? Right? This is how you do it. This is how you do it. Yes, I'm showing. Wait. I'm showing. Don't worry. Wait. You got it? Students, you got it? Please tell me. Have this, check this slide, please. Somebody's want to see it. Okay, my dear students, please stay in touch with me. Stay in touch with me on WhatsApp group. We'll send you more things, more stuff. I have a lot of revision days with me, especially the latest past papers, and also avail that marking facility I've given you. Please avail, please avail. You know, all the position holders, all the high scorers, you in the previous attempt, they availed this marking facility. If you solve the question properly on the software, then you will be in the habit in the exam to answer, and also do the mock exam. I'll also send you the mock exam and we'll mark the mock exam. Just don't solve. Listen, in the beginning, yes, you solve the individual past paper, but in the end, you have to solve complete past paper, because in the exam, you have to kill 4 people at one time. You have a wrestling with four questions, not one question. So in the last 2 attempts, believe me, I got this feedback that students said that we couldn't complete the paper. We couldn't complete the paper because we didn't do the mock. So at least solve 1 or 2 mock, at least solve 1 or 2 complete past papers, so that you can perform in the exam. You paid such a high examination fees as well. You know the exam fee of this paper. So please don't waste your money. Be active, be positive. And that's it for today's class. Take care. Goodbye. Allah Hafiz.